and welcome you all to yet another episode of Fund Manager Interview with PMS Bazaar. I am Aravind Ravindran, your host from PMS Bazaar. Today we are privileged to have with us a man who needs no introduction, Mr. Siddharth Bothra, Executive Director and Fund Manager at Ambit Asset Management. Mr. Siddharth has over 25 years of experience in investments and equity research, and before Ambit Asset Management, he had a long stint of 18 years with Motilal Oswal Financial Services across institutional equities and asset management. Welcome, sir.
Thanks, Arvind. Thanks for having me in the show, and delighted to be here and look forward to your questions.
Now, before speaking about markets, economies, and your flagship PMS, we would like to know about you, sir, personally, professionally, and when did you begin your investing journey? Eventually now managing large amounts of HNI, ultra HNI, and institutional investors' money.
Yes, Arvind. So for me, the investing journey started at a very early stage. I'm from Calcutta, and many people in my family were involved in stock market. So I remember even as a kid, when I was in class 7 or 8, is when I did my first investments in equity markets. So you could almost say that equities was in my blood right from the beginning. Having said that, the lucky break for me, I think, came somewhere when I was in the first year of my college, where one of the professors who was teaching there in one of the finance courses happened to be the head of research of only 2-3 research houses, equity research houses, which were there in Calcutta. And I remember reaching out to him and asking him to take me as an intern. And I got an opportunity to work 2 years as a intern in that equity research house. And that was the beginning of my career in equity research or the equities market. And subsequently, I got a great break where, one of my reports led me to come to Bombay and work with some of the bigger firms. And that's where I got an opportunity to work for almost 18 years with Motilal Oswal, where, for the first 7 years, I was on the institutional equity research, where I was largely looking at several sectors as lead analyst. And another lucky break for me came when I went to ISB to pursue my full-time MBA. And not only that changed my entire perspective on investing. The lucky break actually there was I got a exchange program with NYU Stern, where I spent 6 months, and there I happened to attend all the classes of Professor Ashwant Damodran. I happened to attend many of the strategy classes, and at NYU Stern they had something where they had classes in the evening where the actual fund managers and all came and took classes. So I remember for the 6 months when I was in New York, I was virtually like doing classes throughout since morning till evening. And I think that was a very big break for me because I got to interact with, some of the most leading fund managers, most leading professors or, people who were at the forefront of shaping, thinking around investing. And when I came back from my MBA and the International MBA Exchange at NYU Stern, at the same time, Motilal Oswal was looking to start their active mutual fund. And I got an opportunity to move from institutional equity research to the AMC side. And for the next 11 years, we had a wonderful journey where we started with virtually zero AUM on the active mutual fund. And by the time I had moved off from there, we were almost close to 34,000 crores in AUM there. And during that phase, I got an opportunity to be the lead fund managers for most of the funds there, from large cap to mid cap to flexi cap. And at the peak, I was managing close to around 16,000 crore. So I had a great journey there. And, over the years, also another thing which happened is while pursuing my, investing, which was largely focused on quality and long-term investing, I happened to also develop my style of investing, which is more about looking for companies with pricing power. And the way I see it is that when you look at investing in quality, it could be various ways that people do. Some people look for they're more moat focused. Some of the other people focus more on brands and so on. In my case, I look for a combination of several factors. And for companies where I think pricing power is either dialing up or, it's now getting recognized. And that's been the way I have managed money in recent times. Even now I've also got an opportunity to launch a fund which would be completely focused on this.
That's a great way to start off the conversation, sir. Given your long experience, where would you place Indian equity markets in the current economic and market cycle? Are we close to a peak consolidation phase, or do you think we are entering a new growth phase?
For equity markets, Indian equity markets, if you see, I think when you look globally, there are very few markets which give you the kind of buoyancy or the kind of different opportunities across sectors that India offers. Other than US, I think there are very few countries which would give you an opportunity across sectors, whether it be on the service side, on the capex side, commodity side, and now. The big change for Indian markets have happened in the last, say, 5 to 7 years, where domestic money pool has become as big, or in many cases, bigger than the foreign institutional investors itself. So with that, the market has matured quite a bit. The institutional money, which is both the FI as well as the domestic institutions, gives the market a lot more resilience and depth. And if you take a 5 year, 10 year view, I think probably we'll see one of the best phases in Indian equity markets. Having said that, if I were to talk about a very near-term view, say for the next 1 to 2 years, I think Indian markets could be a little bit challenging, and the returns could be a bit muted. The reasons are simple. It's just because we are coming on the back of multiple years of very strong returns, and because of that, what has happened is that the valuations across the board, whether you look at large cap, mid cap, small cap, or even the broader market, appears stretched versus their long-term averages. And as a result, when we look at the next 2 years, the earnings growth looks muted, more like early double digits, and valuations have room for correcting a bit. So the overall returns will look muted, definitely when you compare it with what you have seen in the last few years. And to my mind, even when you look at the long-term returns of the market, maybe the next 2 years, 2.5 years, the returns could be below that. But that should not take away the the bigger picture, where on a longer term basis, India continues to look very attractive. And lastly, on this point, the beauty of the Indian markets is that while the overall market, this could be my view, but Indian markets is very bottom up market at most of the time. So I believe there will still be many bottom-up ideas which will continue to do as well, or even better than how the markets overall has done in the last few years. So for someone who's a very focused bottom-up investors, I think it continues to remain a very attractive market.
Got it, sir. You have even answered my second question based on valuations. So, how do you think Indian equity market structurally evolved over the past decades in terms of investor protection, liquidity, and corporate governance? And what do you think needs to improve in your view?
Uh, so if you look at the Indian markets, it's come a long way. I remember when I initially started off in the equity markets more in the mid 1990s, it was a very different place. Investor protection was a huge thing. There were so many losses just in the exchange of the stock certificates from the investor to the company and back. I think over the years, the markets has completely dramatically changed. The low point, I think, was when the Calcutta Stock Exchange actually went belly up. In a way, there was this huge issue there. And from there on, I think SEBI has done amazing work. And there are two things which have changed Indian markets considerably. One is the electronic exchange when NSE came in. That took away much of the pain that was there in equity markets to do with the physical stock certificates, the whole issue about transferring, moving of the certificates and so on. And bringing in transparency where everyone knew what's the price, and those kind of issues went away. So I think the advent of NSE and then the pioneering work that SEBI has done has over the years kind of transformed the market. Investor protection today, you could almost rate it at par with many of the global markets in terms of transparency, in terms of investor awareness programs. Another key thing I think was the advent of domestic institutional investors. The whole focus that AMFI brought in trying to focus on investor education. That was one of the most critical things in shaping up the equity markets as it stands today. So if I were to go back in time, I think at that time you would find very few investors. There were very few actual equity investors. Most of them used to view equity markets more as a trading play or somewhere where quick money could be made. I think you have to credit the entire thing to AMFI, to all the domestic institutions which spend so much time educating investors. And as we stand today, I think the whole market in the last 20 years is transformed completely. Today, most of the investors are so much aware of things, whether we look at the media or whether you look at all the other supporting pillars for the market. They all operating and doing their work in a very efficient manner, and as a result, Indian equity markets today would be as attractive in terms of liquidity, in terms of transparency, like any other global markets.
Yeah, got it, sir. So, are we finally witnessing a genuine private capex cycle in India, and how sustainable is this trend, sir, going forward in aiding the growth? And your thoughts on it?
Yes, so when you look at the private capex cycle, it's been a discussion point for some years now. I mean, people have predicted, capex cycle coming back right from, say, before the COVID period. And we have seen some periods, some bouts where, it looked like capex is coming back. And for various reasons, whether it be the COVID initially, then maybe the election time, or small geopolitical issues happening, that the recovery has not sustained. Our sense is that now we are sitting at a point where the capex cycle revival is almost imminent, because if you look at most of the core sector, including power, which accounts for bulk of the capex, the utilization rates for most of the core sectors are at a very high level, where they will need to go for capex. Even if you look at the power front, capex is now really reviving. So our sense is that it could take another 3 months, 6 months, but the capex cycle does look like turning around, and it would continue to have government expenditure, would government capex focus will also come back, which was stalling in the last 1 year. So combination of all this, if I were to take a 2 to 3 year view, I would believe that the capex cycle would come back. The private capex cycle would come back pretty strong within the next 1 to 2 years.
Understood, sir. From your perspective, what are the key structural growth drivers for India in next 10 to 15 years, and how different are they from the past decade?
So I think the key growth driver for India is the increasing per capita income. If you look, the first $1,000 is more about your basic requirements. From 1,000 to 2,000 is where some of the smaller sites, they get discretionary items pick up. So as we move from 20 to 2,300 per capita to maybe around 4,000 plus, what will happen is the consumption basket will change significantly. You will have larger ticket items becoming more a necessity rather than a luxury, which was there earlier. Also, certain basic things like, say, BFSI, typically in a phase where per capita income moves from 2,500 to 4,500, they are one of the biggest beneficiary, because for the first time, people have assets, a surplus to invest in the market. They have enough assets to want insurance. That's when demand for say an AMC, or demand for wealth managers, all this goes up in a significant way. That's when more people want loan for housing, more people want loan for buying cars, and so on. So across the board, you will see consumption theme becoming more attractive. And I think most of the bigger opportunities would be in this particular theme. The other big opportunity I see is that India, despite being a very large country and so on, had been missing some of the larger global opportunities, whether it was in manufacturing or the initial industrialization era. But this time, I think we are more in the forefront of that. I think manufacturing as a percentage is going to increase, and we will play a bigger pivotal role in the upcoming sectors which are there. So these are the 2-3 sectors where I think you will see tremendous opportunities opening up over the next 5 to 10 years.
That's very interesting, sir. Now, moving on to your products, sir. Your core portfolio has delivered tremendously in the recent months, sir. What are the strategic changes you have made in the portfolio which has given this kind of performance?
Yes, I mean, so, when you look at Ambit Coffee Can today, it's come back very strongly in the top 2-3 in its respective category. So the 2-3 key changes we did was, when you look at the way, Ambit Coffee Can was managed earlier, was there was little bit of rigidity in our creation of the universe, where we had some quant filters which determined what our universe would be, which was like, having a 10% revenue growth and a 15% ROCE for each of the last 10 years. And any break would mean that, it would go away from the universe, and, it would not be a part of the investing universe. And when we had something like that, then what happened is that even if we had great companies, what we call fallen angels, where, things were great, but they had one or two not so good year, they would have an issue. Also, when you look at the life cycle of a company, like the way Professor Damodaran explains, where, just like a human being, someone starts off as a toddler and then becomes an old age, and then, starts declining. Same for a corporate. And we felt in the current stage, we were missing companies in the high growth or the early young growth stage. While many of these companies, by the very nature, did not have the requisite criteria to be seen as a coffee can, but we felt we needed to have a combination of both emerging coffee can companies and established coffee can companies, because we wanted to capture not only the matured and the still matured growth segment of the life cycle, but we also wanted to be on the high growth side, and the initial young growth, high growth stage, where the actual J curve recovery happens. So what we did is we said we will have 30% of our portfolio which would invest in the segment which is where we will meet all the qualitative criteria that we look for in a coffee can company, and for the quant requirements, we said it should meet it in the next 3 years. So essentially what we kind of relied on is that when we look at companies, 70% of our weightage goes on qualitative factors as to determining the attractiveness of the industry. When you look at the companies, look at the moats, whether moats are increasing, whether pricing power is there, rating of the management. But for the universe, it was purely quant based, and in our investing decision, we used to put say not more than 30% weight on the quant factors. So with this change, we could make the fund more dynamic, more growth focused, and as a result, many of the companies we bought there, many of them actually went up to 3x or doubled, and kind of led to this recovery for the Ambit Coffee Can. And the other key change, which is related, that we did is we said that we didn't, one of the I think drawbacks we saw, in investing in this kind of investing style, which is quality focused, is we saw that there was too much focus on backward looking, and I would say too much focus on more what you call the static quality. We wanted it to be a quality on a forward looking basis. So we said yes, quality first, but we want these companies to be not only having multiple moats, but these moats should be expanding. If you're looking for companies with pricing power, not just pricing power, but places where either pricing power is going to dial up, or people are now going to recognize pricing power which they had not recognized earlier. So to kind of summarize the second point, I would say we wanted companies which on a 3-year, 5-year forward basis would kind of become stronger or emerge as coffee can, or become stronger, or a forward looking quality is where we shifted our focus from a very static quality. So these were the two key changes which I think helped in reviving our performance in a big way.
That's fantastic, sir. Sir, your flagship Ambit Coffee Can portfolio's earnings has beaten the benchmark Nifty 50's earnings in the past 14 out of 15 years. So tell us, how do you able to identify these kinds of business, or rather size the good quality stocks positions in your portfolio?
So by very nature, like when you look at companies where you're looking for companies which have a history, which have all the ingredients of being a quality company, what typically happens is these companies are more resilient. They have durability, and the key thing in determining the value of a growth company, or identifying growth companies, is longevity. It's not what we would call high growth. So the longevity is the key factor. When you do a DCF of a company, what really changes the thing is how long can you continue with a more than average growth rate. So a lot of these companies, when they have pricing power, they by definition have longer longevity, and these kind of companies are more stable. They have pricing power. So these companies, whenever there's a high inflation or there are medium term issues, they are able to pass on price increases or kind of absorb cost by lowering their cost. and you don't see the kind of fluctuation in their margins and so on, which would typically see in a company. So they are more stable performers, and continue to steadily grow at a steady rate, which is over and above the market. And as a result, the point you mentioned, where on a long-term basis, both on earnings or stock performance and all, they do better than the average market.
That's great, sir. Currently, your Coffee Can portfolio has around 40% allocation in financials. Tell us the reasons behind this high conviction in financial service businesses, and what is your outlook for the sector going forward, sir?
See, I think, when you look at the BFSI sector, just go back 6 to 7 months back, most of these stocks were available at valuations which were at par or lower than the pre-COVID levels. For any good investment, the basis is that you enter into them when valuations are very low. So that was there, and this is a large sector with tremendous opportunity. We had just discussed as to how whenever the per capita income increases from 2400 to 4000, one of the biggest beneficiaries BFSI. So we felt the opportunity which was there in BFSI is that while the near-term concerns were known to all, we felt it was reflected in the price and reflected in the way market was valuing these companies. What was not being taken into consideration is that the fact that if you were to do the intrinsic value of many of these businesses, whether it's insurance, whether it's private banks, many of them have already had 30-35 years of history, and are likely to be there for another 20-30 years. So on a DCF, having a lower growth for the next 1 year or next 15 months did not really move the intrinsic value of the company much. But I think the nature of the market is such that they want to look at the earnings growth for the next 1 year or something and use it as a momentum factor. And if that's missing, they see it as a low growth company. So which I think is a wrong definition, because even a high growth company goes through 1-2 years of periods where growth is not as high or in line with the long-term growth that these companies witness. And the reasons for growth being low were very transient, that the interest rates were falling and some of the companies were going through merger thing and so on, and maybe the deposit growth rate had come down. And over a period of 1 year, 15 months, the prices had corrected so much that I thought most of these concerns were reflected in the valuations of these companies. So we thought it was a great opportunity for any investor who has a longer term view of, say, at least 3 to 5 years. And fortunately, it played out very well for us in the last 6-7 months. And we continue to have a very positive view on BFSI from a longer term perspective.
That's good to know, sir. This one is special and we want to understand deeply from you, sir. Could you walk us through the new product you are launching, which is centered around the theme of longevity and pricing power? What is the core idea behind the strategy?
So for us, as I was mentioning to the investing style is more based on finding companies which have pricing power and trying to create a portfolio which would be a mix of some hidden pricing power companies where people have not identified it, some of the companies where there is some kind of understanding issues, and equally a combination of emerging as well as established pricing power companies. What do we essentially mean by pricing power? Warren Buffett has this famous quote where he says that if you find a company with pricing power which are able to increase prices and not have their demand getting impacted or competitors taking away the market, then you have a great business. So these businesses have following advantages. First, during times of inflation or any temporary kind of blips, they don't suffer as much as a normal company because they are able to pass on crisis, or they're able to absorb costs because they have significant cost advantage versus competitors. At the same time, these are very stable compounders. You look at most of the pricing power companies, like let's start with globally, pricing power companies like say Mastercard, Visa, S&P. You look at many of the top tech companies or across the board. Like whether it be an Apple or a Coca-Cola, these companies enjoy either a cost advantage or they have the ability to increase the willingness to pay, or the price advantage. And in very extreme cases, once or twice you find companies which have both these advantage. So these companies keep compounding, and they are they are less volatile than the rest of the market. They are more stable, and they don't have the volatility that you see in other companies. And lastly, once market recognizes these companies, they on a very steady state have valuation which is significantly higher than the average market. So if you can identify companies which are at the initial stage of getting recognized as pricing power, or kind of establishing their pricing power, that's where you get the maximum delta, because then you can get all the levers that you look for: volume growth, price growth, margin expansion, as well as valuation expansion, which is what you want to do. So this product, as you rightly mentioned, would be focused on finding a combination of different pricing power companies, like the way we talk about it, which is some are hidden pricing power companies, which people normally don't associate with pricing power. Some of them would be emerging pricing power companies. Like I remember when we had bought Eternal or Zomato 2 years back, and we used to call it a pricing power companies. People often used to laugh at us because their impression of it was that it is a loss-making company, and everyone had different things to say about it. But over the years now, people realize that it's probably one of the most strong pricing power company that we have in India, which has an advantage both at the cost side and the price side. So it would be a combination of these companies, and essentially we look for forever companies. Companies as Warren Buffett describes as forever, that they have significant advantage, and these are kind of companies you would want to hold for a long period of time. And when we have a combination where some are established pricing power, some are emerging, some are hidden, some are not yet recognized, that's when the portfolio has the ability to create long-term alpha. Because if you look at a long-term alpha, it's get created by two key things. If you want to create alpha over a 5-10 year period, what are the 2-3 things you need? One is that the most important thing in creating an alpha is that how do you do on a drawdown. So when you have a portfolio which is so focused on quality, pricing power, and top quality management, in a drawdown they do significantly better. The other thing is the way you earn alpha is that on a long-term basis you need 2-3 big winners, because that changes the characteristics, or changes the very nature of your portfolio. So when you invest in say 20-25 companies which have all the characteristics of forever companies, or very companies with growth, longevity, typically 2-3 of them surprise you significantly on the upside. So the way to create alpha is limit your downside and have all the ingredients where the optionality can work for you. And over a 3-year, 5-year period, even if 2-3 of these companies do very well, that's how we look to create sustainable, superior, long-term risk-adjusted alpha.
Very interesting, very, very interesting. So a follow-up question is, what are the key quantitative or qualitative filters you will use to identify businesses with superior pricing power, and how do you evaluate their edge to have that ability to have superior pricing power over time, sir?
No, very interesting question here. So we have talked about it in great detail. We've also written newsletters on it. But let me give you a quick insight as to how we do it. We typically say that we have a combination of both quantitative and qualitative factors, where we give 30% weight to quantitative and majority, which is 70% weight, on qualitative factors. On the quant side, it's relatively easy to figure out what are the things you will look for. Say you look for companies. Say you start with on the margin side. So you want companies which have high gross margins, margins which are very stable. So whatever the narrative that you build for a company, you want to see whether the numbers are throwing that. If you say a company has pricing power, but their margins are lesser than their competitors, or lesser than the industry average, or their ROEs don't reflect the pricing power, then your narration is not correct. So we go through all the we have 9 filters on the quantitative side, where we have filters to first figure out whether the company has quality. The next filter, within that would be to see on the growth side as to whether they are growing higher than what's happening on their market share. Within that, then longevity, we look at whether the Lindy factor is at play here, and then, obviously on the pricing side, we look at the intrinsic value. So we have 9 filters on the quantitative side. The more important one is, our filters on the qualitative side, because that's where you have an edge. Most of your quant filters is something, people can mimic, and whether it's be on the capital allocation side, margin side, profitability side, all those can be mimicked. But qualitative thing is an art and is very difficult to mimic. So we start off here by trying to identify companies which have dominance. By dominance, I don't necessarily mean companies which need to be a duopoly or oligopoly. Sometimes, it may not be visible from outside. Like when you look at, say, an Eicher Motor, overall market share for them may be 4.5, 5% of the two-wheeler industry. But in their respective segment, their market share could be 87%, 90%. So we look for companies with dominance in whatever they are doing. And the second factor is the key one. This is our key filter for a qualitative one. We look for businesses or industries where, we start off by looking at what are the 2-3 criterias that a consumer, 2-3 variables in that company or a sector where the consumer weighs very highly. And then we look if there is a major variance in those key vectors. So for example, say if you say, let's take a case in point, like say if you say hospital, then 2-3 things which would be very important for you is, who are the doctors there, whether they have the modern equipments, what's the location, of course pricing. And then many of the other factors are not critical at all. When you find that, in any industry, in the key consumer thing, there is a huge variance. That is, some companies are very weak, whereas some companies are very strong. To give you another example, say if you look at organized retail, you have a company there like DMart, where the entire cost of operations would be 6.5%. Whereas for many of their competitors, their rental cost itself is 8-9%. So this kind of an advantage, once you kind of keep compounding in a flywheel appears, it's very difficult to beat. So these are the starting points, and then we have a series of kind of qualitative factors which are 6 in nature. And when we kind of combine both, which is kind of make sure that the qualitative ones that we have is also getting reflected in the quant side through either margins or through superior ROE, or through the, when we say we want management to think long term through superior capital allocation, and all this available at a price which to our mind on an intrinsic basis is cheaper than what it should be, is how we look for these companies. On your second part on how do you keep following it, so we are, this is like moat investing in some way. So the critical point to identify is not that whether the company has several or multiple moats or they have pricing power. The important thing is it expanding? If you have moats, are the moats expanding? If you have pricing power, is the pricing power expanding, or they are in a contraction mode on a medium to long term basis? And that's where you go more in micro or more in forward looking kind of numbers, where you create an edge. And this is our secret to kind of identify these companies, where we are too focused on lead indicators which kind of suggests whether it's increasing or decreasing. And that's how we bring the entire thing together.
That's perfect, sir. So, how does this fund will differ from your existing offerings at Ambit in terms of investment philosophy, risk framework, and what are your thoughts on it, sir? How will it differ?
So when I compare it to Coffee Can, there were 2-3 things which would be very critical and different. One is that of course Coffee Can is a PMS. This is an AIF. So the structure and in terms of a lot of other things, AIF to an extent will have some advantage, disadvantage, where people can decide where they want to be. The other is that our Coffee Can is a large cap product. So, we go by the SEBI thing where the mix is between 80-20, 80 large cap, 20 mid and small. Here, it's a flexi cap, so we can be across market cap. So that gives us huge flexibility. The other thing is that, it doesn't have any of the legacy issue which, was there in Coffee Can, many of the legacy points. So here, maybe we can have a larger proportion of what we call as emerging pricing power plays. The third being in our AIF, we are allowed, as per the SEBI regulation, to have 20-25% in unlisted stocks as well. While we have no plans to have anything like that, but it gives us a play where, one or two, or maybe some of the stocks which are almost about to list, that's a space where we can play, which we are not able to do in the other one. So these are the 2-3 key things which I think is going to be different. in terms of risk or in terms of how we find pricing power companies, those things are very intrinsic in nature. So that doesn't change between this and this, the new product that we launch.
That's nice, sir. Now we are going to introduce a new section, sir, a set of rapid fire questions.
Sure.
So you can just answer in one word, which you like or prefer. Which is more important to a business, profits or cash flows?
Cash flow.
What is more dangerous in investing, error of omission or error of commission?
Error of omission, clearly.
Which style of investing you like, value or growth?
If I choose one, growth, but my sense is actually they are not different. There is nothing like growth or something. Everything is value. You want to buy something which is price less than what the intrinsic value is, and so to my mind, everyone is a value investor. It's just that some people find value in assets, or just buying something which is say less than on a physical basis or a asset basis less than what they are quoting at. Whereas the growth is also a value factor, where if a company is growing at a very fast pace or creating a lot of value in future, you discount it back, and that also is a value investing. So we believe there's everything is a value investing, and you buy something where you feel the price of that particular asset is much what you're buying is much less than what it should be. So to that extent, I think any investor is a value investor.
That's a key takeaway, sir. Finally, a tough one, sir. Coffee or tea?
Of course, coffee.
With that, we have come to the end, sir. Thank you so much for gracing in our show. We absolutely loved it, sir.
Great. Thanks, Arvind, and it was a pleasure and honor to be on this show. Thank you so much.
Stay tuned with PMS Bazaar for more such insightful interviews. Until then, bye.